What's up, Wallet Monkeys? Welcome back to the channel. Today what we're going to talk about and distinguish between is sole proprietor, LLC, and S Corp. Now, we shot a video about LLC versus S Corp over a year ago. That video is fantastic. I suggest that you go and watch it. It got a paltry 200 views when we released it, and it totally makes sense. It was kind of out of the wheelhouse of the channel, I guess, and it's not that sexy of a topic. Now, we're about to talk about taxes and deductions and things like that to a degree. I'm not a tax professional. I'm not licensed in any way. Do not listen to me. Go and talk to and consult with your tax professional with all this stuff. Okay, that all being said, let's dive into it. Now, we've been talking a lot about, sole proprietor credit and LLC credit and all this stuff, right? So what's the difference though? Let's talk about what the difference is. Shout out to this video sponsor, us. Recently, we rolled out our credit mastermind, and if you are looking to take your credit to the next level, this might be something for you to check out. So we focus on getting your first or your next $100,000 in credit funding. We stick to a process, a set of steps that we figured out works the best across the boards. And then we work with you one-on-one to dissect your credit profile, get it into position to then hit these simultaneous app sprees so that we can actually get that much in new credit funding. So besides that, we've got a huge members area with, I think right now there's over 50 training videos. There's training courses, videos, you name it, inside of there around the entrepreneurial niche, around that topic, right? Because that's really what we're talking about doing here. We need to take it beyond the money. So getting the money is the easy part. And then we need to figure out what to do with it and build a diversified portfolio. That is what we focus on there, my friends. So now is the best time for you to get started, because as time rolls on, the price goes up. So head on over to walletmonkey.io/credit mastermind. You'll be seeing the link on the video right now, and it's down in the description box. Now let's get back into the video. All right, let's start all the way at the top. Sole proprietor, you are trading as yourself. So when you're filling out a credit card application, you are simply selecting sole proprietor as the business type instead of yourself as an individual, and you're still using your social security number as the EIN, and you're using your home address and all the other personal information. Now, a lot of times on the same application, you're just gonna put in what you're expecting to make as revenue. So you are able to trade under being a sole proprietor for any type of business you want, right? For anything that you want to go and do, be an Uber driver, be a Postmates, whatever it is, right? So nobody can stop you from doing that. And understand that you actually can go and get an EIN on a sole proprietor. I would argue that you'd probably be better off just going and getting an LLC, but you could go do that. And an LLC is when we go and register a business, and an EIN is the employer identification number, is basically the same as a social security number, but it's the identifier for that business. We have to classify it and give it a different NIC code and, make sure that the government understands what class of work or labor that we're in, et cetera, et cetera. But that LLC now is a business. We can put up our personal name and sign on a dotted line on behalf of that. That's called being a personal guarantor. Or if that business has enough credit built up on its own through vendor accounts and net 30s and going out and getting its own credit, then it doesn't need that. And that is the end goal for, I would argue, most people. So let's bring it all the way back down to a sole proprietor now. So there's a new rule with 1099s and that whole mess, which I don't know, man, this triggers me a lot. I'm going to refrain from giving my personal opinion. But okay, it used to be, if this was last year, it used to be if you made $20,000 or had 200 transactions, the platform, whatever it was, being an affiliate on eBay selling, fill in the blank, would have sent you a 1099, and then they're gonna report that to the IRS. Now, the new rule is that it's just $600, just $600. So it looks like the war on taxing the rich is going extremely well, while we continue to attack the middle class and lower earners. So if you make $600 in any sort of way, you can expect a 1099, and a copy of that's going to get sent over to the IRS, which just means that if you're not declaring that and you're not talking about that at all on your tax return, then you're going to be in trouble, okay? And it opens you up to more exposure with getting audits, right? Which none of us want. Understand that with sole proprietor and you, there's no separation between you and a business. So if you're doing something that has a lot of exposure and a potential for blowback, and that blowback could be big, you might not want to be doing this at all. But if you're selling, reselling thrift store items and jeans and t-shirts and stuff like that, you probably don't have much to worry about. Okay, taxes for sole proprietor are done on your personal tax report, by the way. It's just a Schedule C is what it's called. It's just an additional page. And you would just put in your income and tax deductible expenses, right? At some point, you're going to want to move up and bump up to a limited liability company, which just removes and separates the liability from you as a person and the business. Now, this it's not foolproof. It doesn't mean that a lawyer cannot come and start to claw into your personal assets and personal, money and things like that, because they can. It just means down the middle, most people are not going to be able to do that. And, most of the time. And it just separates the two, right? Usually doing your taxes on an LLC isn't different than doing them as a sole prop, but LLC gives you a stepping stone into the tax designation of an S Corp, which is what we're going to talk about in just a second. And so the whole point of that is really just a difference in how much we're paying in taxes, okay? I think that's it on LLC. Yeah, to set up an LLC, you're looking at anywhere between probably $50 on LegalZoom to maybe $500, depending on what state you're in and who you're having do it. I don't think it'd be much more than that. Again, it's a fairly straightforward process. It's not that hard. Then it needs to be filed with the state. There is some yearly stuff that has to be done. Depending on what state you're in, you might have to do a yearly state filing fee, I think. What else? I think that's it. Outside of that, you might have domains, web hosting and things like that you have to, pay for once a year, unless you pay for it in bulk. And that's about it with a LLC, right? Okay, so S Corp. When does that make the most sense? I don't know. And if you look, I'm going to show you this example that we used in the original video in just a second. We base it off a $100,000 example in California. So in California, with how expensive everything is and how much taxes that you're paying, $100,000 probably makes sense for a lot of people. Whereas if you're in Tennessee, maybe 40, 50, 30, I don't know. So I can't give you a definitive number, even though on here I put probably $40,000 or more in yearly revenue is when you want to look at being designated as an S Corp. Understand an S Corp is not an entity. It is really just a tax designation. But you can't just go out of the gates and just go from me as a person to an S Corp. It has to be kind of binded or associated with an entity, right? So LLC is the easiest way to do that. Okay, so to give you exactly what we're doing here, we are simply using the LLC and making an election with the IRS to be taxed according to subchapter S of the Internal Revenue Code. And that's it. That's why it's an S Corp, okay? And so what does this do for you? This simply separates the self-employment tax in a way that could benefit you. Okay, so over here on an LLC, I think it's 15.3% is the self-employment tax on profits. Over here on an LLC, we can't choose how much profits that is. It's just across the board. So we end up usually paying more over here. Whereas on the right-hand side, if we're an S corporation, we get to decide how much is profit. Now, the rule of thumb is that it has to be a reasonable amount. It has to be an acceptable amount. So if you try and say that like 10% is all you had for profits, you might run into trouble. I think 30% is the accepted normal, but you could even go above and beyond that. And the example I use here is 35%. So assume that, again, payroll is 35% off a $100,000 example. That means $35,000. I'll go more into this example in just a couple minutes, but understand that that's the biggest difference. You get to decide how much profit there was, along with all your deductions and everything else. Whereas on an LLC, it's essentially decided for you and taken off of the bulk of everything. Make sense? So that also means that you guessed that you got to do your own W-2s. You probably have to set aside some money for quarterly taxes and anything else that you have to handle on that front. You're also going to have Medicare and Social Security that will be taken out. So you need a payroll service, actual payroll service. So something like ADP or similar, so that you can get all that done. That's going to incur a fee. So you got to take that into consideration. All these fees you got to take into consideration. Any additional things that you might need to get done on a tax basis, probably not. It's not like you're going to get charged a different rate with your tax or accountant or your tax consultant, right? Just make sure that the tax savings more than offsets the cost to set up, operate, and yearly on this game that you're about to play, right? So yes, I think that's all that I wanted to talk about there. Obviously, we got income tax, sales tax, self-employment tax. I mean, there's taxes everywhere nowadays. Let's talk about this example though. All right, so yeah, that was the original example. So some of these numbers have changed. This was federal tax rate based on 2021 on both of these examples. So that's probably changed a little bit. All right, if we look at the $100,000 example, so $100,000 in net business income on both sides, right? The difference is that yes, we've got standard deductions, we got QBI deductions, but there is still $70,000 of taxable income left. And then we're gonna take the 15% off of that. Half of that is deductible, but it's deductible after the fact. So you still have to pay it up front. Then you can deduct it later. So we have a final taxable amount of $64,000 over here, and it's not the same amount over here. In total taxes, we're paying $24,826 in this example. Over here, we're paying $16,558. That's a difference of $8,600. So here, again, the difference is that there's $35,000 in payroll. So we have decided and designated the payroll itself. We control that piece. So like I said, you could say like 20%, 10%, you just might get yourself into trouble and get more audits than you're really looking for, right? 30% is fair amount or fair market value considered. You could go a little bit above and beyond that. And again, you're still making out, but what percentage you do for payroll is entirely up to you. But if you look at that, so the income tax off of the business net income then changes from 100,000 to 65,000. There's the big difference. So we're not being taxed off the 100,000, we're being taxed off of the amount that's left over after we pull out payroll. Make sense? That's the biggest difference. All right, that's it, my friends. Hopefully that wasn't super filled with geek speak and you clearly understood what the benefits are, and now the path of sole proprietor, LLC, S corp, and beyond that. We'll probably shoot some additional videos in the future. That's it for this video. Comment below if you got something to say. Thanks for watching. See ya. Hey, you should subscribe. 60% of you are not subscribed yet. Right there. Okay, bye.